Okay, hello everyone. So we're here today with this very special guest, someone that I'm very excited to have a conversation with and share with you. Some of you know this book right here. It's called The Rule by Larry Hite. If you don't know Larry Hite, well, you should, because Larry was featured in Market Wizards, which was one of the Bibles for me as far as a stock trader back in 1990. So a long time ago, I read this book. We're going to actually go over some of the notes in here that I actually made in this book. If you go in here, you'll see Larry's interview, and I have all kinds of stuff highlighted and underlined and so forth. So I learned a lot from Larry back then, and it's just such an honor to have him here so many years later to be able to discuss some of these things. Larry was featured in Market Wizards, in the very first Market Wizards. He is without a doubt a living legend and someone that I've looked up to. Larry, thanks for being here. I really appreciate you taking the time to be at the Master Trader Program.
Well, thank you. Do you remember I called you? Because I read your book, and there's one page, I sent it to all my grandchildren. You had an account. You were down 12.5% for the year. What you did was incredible, and I'll tell you how it linked to me. You then took the 12.5 things you picked for whatever reasons you picked, but they were definite stocks. And then you said, all right, what if I just would have had a $10,000 stock? Stop. And all of a sudden, that minus 12.5 went to plus 72. And I said, this reminds me of what I did when I started. I was having a debate with one of my colleagues, Peter Matthews. He said, we have a great system. I said, no, I tell you what, a kid walked in named Alex Raisman, and he's getting a PhD in statistics. I said, build me, let's say we make 3,400 trades a year. Build me a random generator. The random generator will pick what we trade, and then it also will pick long or short. But everybody must have a 2% stop. That's it. So what you had done, you started with stocks that you picked. I said, no, I'm randomly getting them. And what that showed me, how important money management was.
So, yes, I made that adjustment. I also did a very similar study that you did, only what I did was I threw darts. I put a whole bunch of stocks on the wall and I threw darts at them. And then I applied stop losses. But what I did was I selected them among a list of very high momentum names, very high alpha names. So there were names that had a lot of momentum to the upside. And so they were names that had the potential to be big winners on the upside. I threw darts at them, picked them, and just set stop losses and found out that, guess what? It even worked there. It even worked if you managed the risk properly. There was a mathematical point at which it made sense where you cut off the downside and you let the upside ride. So from a bunch of different angles, I came to that conclusion that you came to.
Look, I love to study outliers. Every major collapse started with a small loss.
Right.
Everywhere. You can't say long-term capital is an extremely good example, because here you had one of the best bond traders in the world. You had 2 Nobel Prizes.
Smartest guys in the world.
Smartest guys in the world.
Yep.
Yeah. The giant disaster.
And the biggest disaster in the world.
Yeah. Yeah. By the way, I'm not seeing your face. I'm seeing something right up a sign. So, but I want to keep going with you because as much as you're interviewing me, what you did was incredible to me. And it's what I guessed, that money management is the key, risk management.
Yeah.
And
Larry, we also might want to point out that with those high pedigrees and all those smart minds comes an enormous amount of ego sometimes, right? And that's sometimes what gets you into trouble when you're maybe a little too smart.
I put everything in algorithms, and I use computers. If Larry Height was doing it and I had to make decisions, Larry Height wouldn't be sitting here.
Right.
You gotta tame your decision. I don't want to make a decision on the spot because I don't have a playbook. When we do it, we win because we have a playbook. Look, there are only three things that can happen with a price. Goes up, goes down, or stays still. And so you've gotta, that's your only tool. I once wrote a paper on the applications of game theory. And if you go back 30 years ago, when I wrote this paper, there was the floor, right, where the executions were done. And there were guys on the floor. Then there were the people who used the commodity. They had the best fundamental knowledge going because they used it every day. I had worked with man. I saw them arbitrage brown sugar for white sugar, etc. So what was the advantage that a futures trader had? Easy. He doesn't have to trade. When you put up on your dartboard companies that were moving.
Right.
And let me tell you something. If the market don't, like in Cuba, you can't make them, they have an exchange. But since they have fixed prices, you can't make money.
That's right.
I didn't put this in the book, but it's very important. I believe in a thing called asymmetrical leverage. And it's really simple. Think of an option. If you buy a call, you know exactly how much you're going to lose. Exactly. But you don't know the upside.
Right.
But when you know the downside, you have tremendous advantage because you can make multiples when it comes, and you can lose just what you can lose. That is no matter how. I don't know how many guys, and maybe you could tell me, that went broke that used stops, because I don't find it. The only people I saw that did that were people who averaged down.
Yeah.
And those people, they go out of business.
Managing that risk reward relationship is something that I learned from you. I want to go back to the Market Wizards book. So these are really key things, just so everybody can understand. This Larry Height was totally instrumental in forming Mark Minervini's way of trading and my whole approach. Larry's interview really resonated with me. Paul Tudor Jones is another one that was a huge influence on me. But I'd probably say you and PTJ were really two of the biggest influences on me, particularly about risk. Here's a sentence you said: while you can't quantify reward, you can quantify risk. And here's one of the things, and I can see why you might have been, I know you called me and you said you were a fan, you liked my book and so much, and you felt like we had a lot of similarities. Well, one of those reasons is because I followed in your footsteps, and I think also, we're talking the same language, but you're talking the same exact language as you talked 30 years ago, however many years ago, this book in 1990. Nothing's changed. I want people to realize, Larry, explain everybody thinks the market's changed. Everything's so different. Yes, it's faster. It's definitely faster, and we've got technology. But do you think really anything's changed in particular about risk versus reward, or making a decision, based on supply demand?
Okay. There's one fundamental in the market that's always there. And you know what that is? People. I do not see a great change in people. If there's 12 guys on a corner and a really well-proportioned lady walks by, their heads are going to turn. And that would have been back 2,000 years ago, or they wouldn't be there. I mean, people are built in a certain way. I read Jesse Livermore's book, and Jesse broke his own rules twice. And last time that resulted in suicide. So to me, once you understand that people are the one fundamental, and about fundamentals, people write fundamental papers to get attention. That's their job, right? What do you do when you want to communicate with somebody? You try to tell a story. Every story is an exaggeration. Otherwise it'd be dull. So we don't even know how good the fundamentals are.
Just want to point out too that you're seeing with all these special guests that I have during this year's Master Trader program, it's really quite amazing that I was able to put these great people together, and it's just such an honor for me. This is my lineage. These aren't people that I just selected out of a hat. These are the people that I learned from and that I continued on with their work, and now I'm passing that work forward, and you'll continue on from my work and their work, and maybe someday you'll be doing the same and passing the torch forward to either your children, or who knows, maybe you'll be writing the next book, right, Larry? But what I want to say, Larry, I want to ask you, and again, as I go back and I read these notes, and I haven't looked at these books in many, many years, I see, now I see why I am who I am and how I trade. You said here, or actually Jack Schwager says, you use increased volatility. He's talking to you now. You used increased volatility as a signal to stop trading.
David Dodd, who wrote with Graham, Securities Analysis, and he said, the market's two things. One, it's in the end a weighing machine. How much do you get from it? The other part of way, it's a voting machine. We have come to a time in the world where it's much more a voting machine.
Right.
And so I adapted that. I turned, Charlie Munger said, if you want to learn something, invert. I said, okay, now I'm following the votes. It's not only how much it moved or didn't move, but how much was it, how many shares, how many contracts went compared to an average.
Right. It doesn't matter. I say people move stock prices, not value. It's the perception of value, right? It's the perception. So if a Van Gogh painting, it sells for 50, 100 million, but the paint and the canvas is worth $30. It's the perception, and that's where, again, let's go back to the Market Wizards book here. This is, again, I'm going to my underlines. If you can see here, I don't think you can see it, Larry, but I'm showing it on the screen here. I'm going to all the things that I underlined, many years ago, in 1990. You said here, and this is again, trusting the verdict of the market. If a market doesn't respond to important news in the way that it should, it's telling you something very important.
Then the voters are not going. Because, look, we now have a huge industry of people who are trying to match the market average, right? What are they really doing? They're actually trend following because they got to go to where the money goes. And they're not even trying to outperform. But there are billions of dollars of trend followers that never think of themselves as trend followers. So the game...
Just to make your point too about voting versus, even the fundamentals, not that we're saying that, we don't want, it would be great to have the fundamentals and the technicals and have everything, but we don't always know, what the market is trading on and what it's valuing. And the .com era, myself, you can go on YouTube and there's, videos of me saying some of these companies have absolutely nothing to offer and they're going to go bankrupt. But I made a fortune in them. But I rode the elevator up and I got out before the cable snapped. And I knew that many of these stocks did not have the fundamentals, but it was the mania. It was, the voting, the voters where it was a stampede of voting for those stocks at that time. And I took advantage of that. And that is certainly the power of trend following, as you're saying.
Our great magic power was we know we don't know. We don't.
Right.
Look, I've made a lot of money, like a lot of people, in Amazon, which I think is fabulous running company. But I couldn't tell you the marketing directors. And so if I knew the marketing director, that's not going to tell me. The price, I believe the price tells you how everybody goes. And
I often say that I'm, when people ask me about my success and my strategy, I tell them my strategy is built upon I'm smart enough to know that I'm not smart enough to know.
That's exactly true. But look, I can get out of this. Think about the last 20-year war that we just got out of. Now, they had all these smart people. Nobody asked what they're going to get out of it. They were just trying to stop Russia. It's been 20 years. How do they do that? And these guys have all the information, and we've seen that we all don't know. So I think I have stopped about everything in the world except my family's health. That you have to do what's right, even because it's the last thing you got, right? I mean, but everything else, I want to know where I'm going to stop it.
There's something else here that I have a big giant star next to. And again, like I said, all this is so clear as to, why a lot of the rules that I made. And, I read your interview and it really resonated with me. And then, of course, I validated it in real life over my career. But here, your final words in Market Wizard were, I have two basic rules about winning in trading and in life. 1, if you don't bet, you can't win. 2, if you lose all your chips, you can't bet. So, I mean, that really resonated with me. And, I created my whole trading strategy around the approach that I can never even take a 1% chance of losing it all. Because at some point, if you trade long enough, that 1% is going to rear its head, right? You said you like analyzing the tails and the aberrations, and the fat tails of the curve and so forth. So that's where you can, you only have to have that once in a lifetime event happen one time and you're blown up, right?
You're like a general, right? You lose all your troops, you're no longer a general.
Right.
I mean, so risk management is all. Because I don't know, everybody's having a great time in the stock market now. Okay, I have stops in everything because I want to know what I'm risking. I don't know how far it'll go. I mean, but I know what I'm going to lose. And I start off with what I can lose, And I like to keep it a certain percentage. And I adjust on my core capital.
Your loss side is really the only thing you can quantify, right? I mean, it's really the only part that you have absolute 100% control of and can absolutely quantify.
100% correct. The only part. You don't know what the government's going to do. You don't know the weather, right? You don't know the international situation. But you can, it's like I said in this application of game theory, you could choose what you bet, what the relative risk you're taking. You have complete control of that. From then on, that's it. You have no control. It's like having your children. There's a thing with your children where they become themselves.
I'm starting to find that out. I have a 15-year-old daughter, so I'm learning that right now.
Well, they become that they can go. So I have two daughters. They get into a car. You have no control, and so that's an illusion. But
let's relate that to stocks, because let me real quickly tell you, and I know you know a lot about what I do, but I'm always trying to get an idea, a good gauge of how much I can expect, not every time, but over time, on a bell curve, how much I can expect on average on the upside of my trades, and how often I'm going to be able to get that upside. So for instance, if I'm getting an average of 10%, profit on each trade over time, on average 50% of the time, I now the risk side becomes a mathematical equation. Now I know where I can adjust that, just similar like an insurance company tries to peg where the people are going to die as a group, and then they set premiums.
I did it the same way you did it. I got laid out diagrams of trades, right? Let's say like a 12-week high. And I ran 1,000 of those, and I got the average. In my book, they said I beat the average, the guy who wrote the PR. No, I didn't beat the averages. I did what you did. I used the averages. I always look at how much my winners over 1,000 plays win and how much my losers are. And I want a ratio. 2-to-1, 3-to-1. I do exactly because I got a big enough sample and I know. Now, do I know precisely? No, I don't. But
you don't have to know precisely, right, Larry? You don't have to know.
So, one, you get an average, and that's your beginning, but that average will vary.
Right.
But you know exactly how much you're going to lose. And I do the same thing you did. I thought for a moment you were telling me you knew, but now you know the same way I know. I average them. Right? Look how many years we've been doing this, right? I'm 50 some odd years into doing it. And the best I can come out is watch my averages. But
right. We're in a business of probabilities, right? No absolutes. We're not going to be able to peg it exactly, but like the insurance company and even casinos operate on this same philosophy. They're operating on this very small edge, and they're turning it over, and they don't know if one guy's going to go on the crap table and roll for 2 hours and make a big profit that's way above what their average player does, but it's over all the players and their average, right?
I looked around trying to find people in the stock market that make money shorting outside of market makers. And I can't find them. We're trend followers. I know personally know 2 dozen people who follow money management and trends, and I've never seen any of them go broke. But I can't find people, if you keep your discipline, you win. Another book I tell people about is Darwin, Origin of the Species. When he talked about fittest, he was not talking about push-up. Most adapted to the environment. That's what he meant, statistically. And that's the key here. And you found it, and I found it, Livermore had it. That's the way you win. You are in the risk transfer business, right? You don't want the corn to wind up on your doorstep one day. You're way before delivery.
I love that because it's so old school. When I'm not sure if many of our viewers could even know what it means to have to take delivery of the actual underlying commodity. Right? We never wanted to take delivery, right?
Never. We have
to actually own the underlying commodity and own the corn or the gold or the pork bellies.
We are wave riders. And every wave ends the same way. And that's what we do. We ride the waves. But it has been the most consistent. Alex Raderman and Katie Kaminsky wrote a book, 800 years worth of data. And you and I could have traded.
The tulip bulb craze.
Yeah. We would have went in and we would have gone out. Right? Now, would we have known? No. But we know exactly how much we're willing to risk. And we know that we make money when the trend is going in our way. And we follow with a stop. Period. That's us riding a wave. Right? It's that simple. But without the wave, we're going nowhere.
Let me ask you, what would you say? I was really struck by I did a little poll on my Twitter page, which has about 300,000 followers. And on the poll, it was a pretty big sampling size. It was, I think, tens of thousands of people. It was, certainly thousands of traders responded to it. And I asked, how long have you been trading the markets? And lo and behold, it was like 70% of them were less than 2 years. And maybe like another 15% were 5 years or less. Almost nobody had more than 5 years experience. So we're in a time where there's a lot of young people and there's a lot of new, and I think it's the same all the time. As a matter of fact, this is a business of that the names change all the time, and there's not many people that can survive over the long haul. So there's always new names, but we have a lot of young people, a lot of people that haven't even seen a big secular bear market or gone through many cycles. What would your advice be to how to become the next Larry Hite, the next super trader, if they have high expectations to become a great trader? What are the real core principles that you've made a career on?
Go look up. There's a guy named Jack Boyd, and Jack was the only guy on Wall Street who had a paper record, but it was a record. So I left one job to work for him for less money. My father thought I was insane. I said, no, if this works, it's better than a salary. I'll be independently wealthy. And I was. First of all, I would look at every chart. Cheap. I see the waves and think about you and I personally, how many guys friends of yours, that follow basically the rules that you and I talk about? How many of them have gone broke?
Well, we're religiously following the rules.
Yeah.
I can count them probably on my hands, but the very, very few people have followed my my rules and my discipline religiously to the T.
Correct.
There are a few, and they've done really well, and they've become, very accomplished traders. But most people, do not follow those rules religiously.
But now, why? What? Here, everybody thinks they have great formulas, but the people who do well at what we do, like Ace Greenberg, used to say, it's really simple. Buy a stock, goes down, get out.
Yeah, people think I'm facetious when they ask me, what do I do and what's my strategy? How are you successful? I say I buy stocks that go up and I sell stocks that go down. And they think that I'm just trying to, blow off the conversation, but that is really an accurate description of what I do.
I have a friend of mine. You remember the song by the Beach Boys, The Little Old Lady from Pasadena?
Yeah, of course.
Okay, she's like that lady, right? So she got some money from her grandfather, and she started buying stocks. I said, "What do you do?" Well, I buy them. They go up. I keep them. If they don't, I get rid of them. Well, so that's it. She said, "Larry, I buy them to go up. If they're going down, that's not what I buy them for."
Pretty straightforward.
But it's the truth.
It sure is.
It's the truth. Now,
when you bought it, you didn't think, when you bought a stock, I tell people, when you bought the stock, you didn't think it was going to go down, because if you thought it was going to go down, you would have waited. You wouldn't have bought it. So once it starts going down after you bought it, it's there's not much more that can tell you that your timing was off. That whatever the reason was that you bought it, whatever your case was that you built, it wasn't on target. It wasn't the timing wasn't right. So you can be wrong or you can stay wrong. So if when I'm wrong, I admit I'm wrong and I move on. And sometimes I even come back to that same stock at a later date.
And I will tell you something. I don't know how old you are.
I'll be 57.
Okay. If you traded like you trade, you'll never die broke. Period. End of story. Because that's the way the world works. And I have found, I wasn't a good student, but I've had PhDs work for me, and they were very bright people, but they couldn't take losing. I was at someone's house at a lunch. There was a famous writer, a son of who owns one of the biggest metals trading companies in the world, and a great entrepreneur. And they had read my book. So the guy said to me, "Larry, what if you didn't have these handicaps? Where do you think you'd be?" I said, "Not. My handicaps weren't handicaps. They were my blessings. Because they made me think. And one of the great things about being blind is you fall a lot. And from falling a lot, you develop a great talent getting up."
Right.
Right? So I take falling, that's the rent we pay to get in the game. And I can tell you, I didn't have a computer, so I dealt my hand, thousands of hands of Vegas solitaire, but I was allowed to go through. And I found no matter how many times you go through, if it's not in the deck at the right time, you lose. So even cheating, you lose. So you gotta, and that taught me a great lesson. you will lose. And Terrence O'Dean is a guy in California, and he's an economist, pretty good economist. So he goes over to a large brokerage firm, very low commission, forget the name, but world famous. And they give him 10,000 accounts to study, not the names. And he was puzzled. He said, he doesn't understand something. Why do people sell their winning stocks to go into losing stocks? Right? And I thought about it for a long time. And I was reading I read anything that comes, right? And I said, when you have a win, you get a little piece of dopamine drops. When you have a loss, you don't feel good. So people will ride a stock down 50%. When it goes back to that point and maybe $1 more, they get out. Now, you and I know that is a breakout.
Right. Hence,
right?
Hence the concept of overhead supply.
That's exactly right. It was harder to go up if you're down 50 because you get all those people selling on the way up, right? When you make a new high, there's no overhead supply.
Right.
But people who do this saying that they got their money back. The fact that the stock was down 50% for 2 years. My mother used to me, and my mother knew math. Well, Larry, you didn't take the loss. No, I said, you don't get it. If I'm there, I have the loss.
This is what the average investor does. And one of the things I want to ask you is, and I'm always asked these questions, how you're talking about doing things that are counterintuitive. A lot of what you're saying to you and I, this makes total sense, but to a lot of people, it's very counterintuitive. How did you cross over? I know how I did, but how did you cross over? We're not born with this. Like, we're not born as a stock trader. We're not born with this natural ability to think counterintuitively. Did you learn this? Did you have to blow yourself up?
No, I'm not kidding you. I learned because of my disability. Think about it. I couldn't see, and I grew up in a place where ball playing was a lot. Well, Ted Williams wrote a book about how to hit baseball, and he divided the plate into 64 squares, and found out his place was in the bottom right-hand side. So I said, oh, shit, I understand probabilities. So I go up and I was playing racquetball. I had taken some lessons. I sucked. Why? I'm blind. That's it. If you can't see, baseball really doesn't work out well for you. And that meant that I fell a lot. I was in London with Stanley Fink, and I slipped in the car, and he said, Larry, you slipped and you rolled and you jumped up. I said, how did you do that? Are you a trained acrobat? And I said, no, Stanley, I fall a lot. And so basically, if you're not a masochist, you say, hey, that didn't work. Okay, what would work? And that's what you and I did.
Yes.
Right? Is we were concentrated on the outcome. We had a goal. Right? If you're sitting in Miami Beach and you go to Cuba and you wanted to get to New York, you've gone the wrong way. Right?
Right.
I was in a meeting one time when I was younger, And I was really good in the meeting. So I'm puffing myself up. That really was good. And I was going to visit my parents in Brooklyn, right? And I'm telling myself how great I am. And then I look, and I had gotten on the wrong train. I wasn't going to Brooklyn. I was getting out. So I had to get out on 125th Street in Harlem and get down. I said, thank you, God. You reminded me how I could lose.
And you seem like someone who, you don't take very long to learn a lesson. You're looking for the lessons, it seems like, all the time.
Well, I got to this story. I'm living in the West Village in a kind of a tenement, but it's nice, clean block. And some girl, she had this boyfriend, and every once in a while he smacked her around. So she's going to jump out a window. And there's two guys in the building, me and this kid, Harry. So we talk her out of the window, right? And I noticed, so Harry and I became friends, right? And every morning, and now I had girlfriends, and they slept over, but Harry always had a really good-looking girl. But they were different, right?
Harry was a player.
Yeah. So I said to Harry, how do you do that? He said, and this is where I got my training from. He said, well, here's what I do, Larry. To get through law school, I sell computers. So I'm always walking around. If I see a really great-looking girl, I go over and say, he said, I'm Harry. You don't know me. I don't know you. Let me buy you a cup of coffee. He said, 1 out of 10 of those goes for coffee, winds up sleeping over. Now, I'm a 30-year-old guy. I said, shit, this is interesting.
It's a probabilities game.
It's a probabilities.
It's a numbers game.
I wanted to really, you know what I want? I thought I was going to have to give a lecture. This is so much more fun. And I wanted to call it Sex, Drugs, and Rock and Roll. Because it was looking at girls that way. It's like, I didn't care if I got a yes or no.
Right.
Because the probabilities would work for me.
And there's the lesson. There's the lesson. You didn't care if you got a yes or no. You didn't care if you got 9 no's in a row, because the yes, once it came, paid for the no's, right?
Exactly.
Just like the reward pays for the risk. So you got to just manage that risk so that in relation to that reward, and that's the secret.
Look, I did a favor. I do favors when I can, because I've been very blessed. With all the handicaps, I've really been blessed. So I did these guys from Texas. I sort of helped them straighten their company out just a little bit. And they were backed by a very rich family in Texas. So they said, what could we do for you? I said, well, if I can, I'd like to meet Roy Hunt. And so I went to the oil, I flew out to Texas, to Dallas, and Roy Hunt and I and these guys had lunch. And I said, Roy, here's my view of your father.
Roy Hunt as in the Hunt brothers.
Yeah.
Right.
Yeah.
Yeah.
And Roy is the most successful of all the Hunt brothers. And his sister's not bad either. She's about real genes. And Hunt always had like 3 wives. Right. So I said, I don't think you're Your father was a real oil man, but he was a great gambler. And looked at him, he says, you're right. Because what Hunt would do was, when he saw the big oil companies sniffing around, because he was the son of a preacher, a Bible Belt preacher, he'd go to the farmers before anything was done and buy up cheap options.
Right.
And he said, yes, that's how my father did it. And I knew that. I knew that because
one of the great speculators of our time.
Yeah. Their biggest thing was Placid Marshall. And he won that over a poker table.
You know, I want to point something out because you've mentioned you've dropped a lot of names in the last 40 minutes or so. You've dropped all kinds of people that you've known and you've hung around with, or you had lunch with, and so forth. And it seems like almost every single person is like a legend. You know, you and this just makes me feel like, you know, you kept really good company, or at least, even like me, you were a mentor to me and didn't even know it. You know, I call it forming your board of directors, where, you know, I had a board of directors early on when I was a teenager and in my 20s, and I formed those board of directors. Larry Height was one of them. Paul Tudor Jones was one of them. William O'Neill was one of them. You know, they didn't even know it, but I was studying their works and having them advise me. But it seems like, you know, again, I look back and all, you know, and of course, some people I know personally, but a lot of them, you know, I was fortunate to study their works, and they wrote books. And that's one of the reasons why I write books, because I feel like that's the way to pay it forward. But yeah, it's like, you know, everybody you've talked about is like, you know, or all these, and I love these names that a lot of people might not, you know, some of you that are young, you won't know who Ace Greenberg is and all these people, but these are legendary Wall Street people. And Larry, you've really, I mean, you've really been there.
But I've been like you. I find somebody who, I can detect the methodology. I hate to say this.
Say it, because I love to hear the things that people hate to say.
Let's say what schools do and who invented schools. In England, what schools do is prepare you for a job.
Yeah.
It's like the army. They want you to do what they want to do. That's your job. Right? Right or wrong. Look, let's face it, you and I had two advantages that were really important. One, we were born in America.
Absolutely.
That was, and those.
We hit the genetic, when it comes, I tell people, you're born in America, you hit the genetic lottery.
That's exactly right. That's exactly right. And then the other thing is, the guy from the Turtles said, people who come in rich don't mind their losses till they're broke.
Right.
When you start with nothing, you really understand what the loss is. If you have too much of a cushion, you get lazy. You don't think about, wait, how did I lose this? What happened? What else could I have done?
Yeah, yeah.
And that's, so in that way, your lack of education was a boost. Think about it this way. All your teachers don't earn a fraction of it. And I'm not saying money is everything.
No,
but I'll
of course
tell
not.
you
But,
right
we
now,
are talking about success in money and trading.
Yeah.
In trading, money is everything. That's the final score.
that is the final score.
Yeah.
So you say to yourself, that's the game. That's the game. Yeah. That's the game we've chosen. Mm-hmm. And I went to school with some very smart people. It was a high school, but it was Carol King went there. Chuck Schumer went there. The guy who had the Jets went there. A lot of my school did extremely well. And you and I, because we wanted something, and Tom Bessis is exactly the same. He tried to learn to do commodity trading. It took him 7 years. You had a time in the wilderness, but you stuck at it because it gave you not your money. There's one great thing for you. It gives you freedom.
That I looked at trading as a way to get free. I did. I looked at
that's exactly what money is.
From a couple of things. One, from going into a structured job in a monotonous situation where I was being told what to do. That was one freedom, to be able to operate at something that I was passionate about. And the other was, of course, to get wealthy and then to have financial freedom. So I think, but I often say that if I had not become successful, I probably would still be at it today trying, because and I wonder what your feeling is about this, as far as when you start off with trading just for the money and you don't have any passion for it. I find that those people burn out because success doesn't come as fast as you would originally expect. So you really need that passion and that love for the game to get to the point where you get good enough to get the money. What are your feelings on that?
If you and I went to lunch, we'd probably have a very boring lunch. I'll tell you why. For better or worse, we're at the same mindset.
Yeah.
And I remember one time a friend of mine got me a job in a malted shop. And in Brooklyn, on a Saturday night, ladies went there with their husbands, and they wore fur coats. Okay? So I'm not well coordinated to begin with, and I'm making a malted, and I didn't pay much attention. I can't see. And all of a sudden, there's like 10 ladies and their husbands, and my wrist goes wrong, and the malted goes right across the front row. I said, okay, you all had some. Who's going to pay? The manager gets out and says, you're gone. I said, no, I need my friend. He works here. I can't. He said, go sit in the back. You don't have to work. I'm paying you for the day. Go. Right? So, all right. Now, imagine a life of doing that. Right? And I love this kind of conversation. And I love when I put together an algorithm and it makes me money. And it makes me happy. I don't have to work. You don't have to work. But we're sharing the passion of what we do. So to talk to anybody who's good at this thing.
Yeah.
I spend hours on the phone. Mike Covell has become a very good personal friend of mine.
I'm friends with Mike, and he's a wonderful guy.
Yeah, he's a great guy.
Yeah.
And so I meet people who understand. I will say there is a mindset, a mathematical mindset you got to have. You got to respect numbers, and you got to be able to think in numbers. But if you understand what we all learn, and I don't care what you say about it, we all, to be successful, have to be risk managers. If somehow or other you believe that God gave you luck, you don't need anything because you are special, you are dead in our business. Because the market doesn't give an F about who you are.
And luck only lasts so long, right, Larry?
Yeah. What doesn't last long is cut your losses short and let your winners run.
What does last long, you're saying?
That, yes.
Yeah.
That is me. You wouldn't be interviewing me if I hadn't that rate, and you wouldn't be who you are.
That's absolutely correct.
And and so you and I had the luck of being born in America and the pleasure and freedom to do what we like to do and get paid enormous amounts of money compared to the average person.
Yeah, I'm truly fortunate and truly blessed. There was, of course, you put in a lot of hard work, and it doesn't just happen, but it's an amazing opportunity. And Larry, I just want to point out or get your take on. I feel like that opportunity. Some people feel like back in the day it was easier, and it was so much easier. But you said something a little while ago about hand plotting charts, and even up until I came after you, and I had a hand plot charts. We didn't have any charts on computers, and I had to guess where the price was throughout the week and sort of put it on a daily bar graph. I got weekly charts, and then I'd update them, and just had one little blinking light of the last trade. Even before that, I was operating from the newspaper. I didn't even have quotes. So I mean, I feel like the opportunity now is better than ever.
Oh, for sure. But I would tell you something. Win or lose, we love the game.
Absolutely.
We could stop now. People said, well, why don't you just stop? I'm 80 years old. This is what I love to do.
Yeah, my wife says that all the time.
Our hard work was playing hard. And, and that's what the game's about.
Yeah.
And that's it. And
what is your advice for, someone new who's just starting in the market? They're fairly new.
Expect to lose. That's part of the game. If you don't enjoy this, leave. Period. Because you had one other low middle class disadvantage that we all. I once turned $500,000 into $12 million, and I was like a deer caught in the headlights. I had no one that had ever gone through anything like that to talk to. I planned how to do the trade, but I got extremely lucky in the trade. Okay? And I didn't have a plan. I didn't go crazy. I didn't lose the money. But I had found some incredible stuff. But I wasn't, and I did something really wrong. I said, all right, how many times could this happen? Because, you can't make a living with. Turned out that was wrong. You can. You have to have a plan, not only how you lose, but if you get, when you come from backgrounds like ordinary people background, how are you going to handle it? Because now you're in a different position.
That's a fantastic point. I want to tell you, and that, coming from my background of poverty. I mean, really, never having any money and watching my mother, constantly struggling in my household. When I finally got some success too, it was a very strange place. It was something that I had to learn how to deal with. And even on the upside, when I spent so much time trying to figure out what stock to buy, when to buy it, that I never really considered what to do once I got a big winner. And I was in that position. And that was a whole new learning curve that took another 5 years to figure out then how to keep the money. There's one thing to get it. Now, how do I actually keep it?
Right. And to realize that's why game theory, I thought it was very interesting, because your place at the table has different edges. If you're the first to bet or the last to bet, right? So every time you have more chips or less chips, you have to adjust. And you have to have some idea of what you're going to adjust to. What is the bet? What is the plan? And you don't have many people to talk to. The guy who was once head of the New York, Chicago Merc, I forget what his name, with an M, but so he started, he had this trade in silver. And then he and his partner made $3 million. So I said, wow, boy. And they left the game based on some fundamental BS. And of course, silver then went up to $50. Even he's a lawyer, he didn't understand how to deal with winning. And you really got to know to understand winning. And you have to adapt to winning like you adapt to losing.
Absolutely.
You know what I mean?
And and Larry, this doesn't all happen. This is one thing that people have to understand, that this doesn't happen all at one time. This happens over, and it doesn't even happen over weeks or months. It happens over years. It doesn't. First, you start, on step 1 and step 2, and you think the staircase maybe has 8 or 10 steps in it. And when you get to step 8 or 10, you go, whoa, there's 10 more steps. And that staircase kind of never ends. It just, it's kind of like golf. You're never going to shoot an 18, and we just keep trying to, get that perfect score. But this is a business that it's just constant learning, right?
It is, and constant adjustment.
Adjustments, yes.
That's what Darwin's point is. You adjust. Cats from the north have a lot more hair than cats or in the south. They grow their survival. Nature takes care of them in a way.
What I want people to come away from this is that, when we go and we look at someone like yourself who's been doing this for so many years, as the generations go on, I'm not really doing anything different than you did. And the guys that learn from me that are doing really great now aren't doing really much anything different than I did or you did. And there's nothing's really changed, right?
That's why I called it the rule. All your wealth comes. You have learned to have stops, control your risk. Everybody I know who made very big money, if they don't control their risk, eventually they die financially. It's almost a matter of moral courage. You are not going to, if you do not play the game, you roll yourself out. Right? I mean, it's a lot like dating.
I like the description. I like the term moral courage, because that really is a very, very accurate description of it, of sticking to your principles and having the courage to cut your losses. Does take courage. It does, and it takes belief in the outcome, because at that point you're at a loss. So you've got to believe that the reward pays for that loss. How do you get that? How do you get that? People always ask me. It's nice that I can ask you, because people always ask me these questions. How do you get the courage to do that? How do you stay? You're taking a string of losses. When you're taking a string of losses, how do you stay with it?
You stay with your money management principle. It becomes like your reflex. Look, if you're a boxer, right, you can't get in the ring and think it's strange that somebody's trying to punch you in the face. That's the game.
Right.
Right? Yeah, you don't have to be a genius. He's in the ring. to punch your lights out and win, right?
If we use your rules, if you get knocked out, you're out of the game, right? So,
correct.
So the first rule is not to get knocked out. Even before you're going to try to punch the other guy's lights out, you got to make sure you're not getting knocked out, right?
Yeah, and yet here's a very simple way to do this. The Turtle books are really good about this. You decide how much you're willing to risk. You start with what you're going to lose. Then you look at is that a big part of your core capital or a small part? It is better to undertrade because you can go, there's a part where your position is too big for your emotions. There was an old saying, I forget the guy's name, but he was head of the exchange in Chicago, and he met a friend of his, and the friend said to him, I can't sleep. He said, why can't you sleep? He said, oh, that corn position is driving me crazy. And the guy said, cut down till you can sleep.
Yeah, we call that the pillow factor, sell down to the sleeping point. But we've termed that.
Sell down to the
my assistant actually has termed that the pillow factor.
Okay, but it's true. You don't want to lose your emotion because no one, unless you've been through this a lot of time, and you learn to. Some people like losing. They love to tell the story. I like the math, but I don't need to tell stories about losing.
That's real. I gotta stop you there for a second because that is so interesting. I say that all the time that some people actually like to lose, and people just think that's crazy. Why would anybody like to lose? But because there's an excitement. There's an excitement to it. People go to gamble and they gamble at the casino until all the money's gone. Absolutely. And until all the money's gone, the excitement is there. And they'll just keep that going because that's the adrenaline. And to keep that adrenaline going, you're going to lose it all, right?
But you and I don't gamble.
No.
We are the house. And I'll prove this to you. We set what we're going to buy, how much we're going to risk, and when we're going to get out. And if it doesn't go to making a new home, whatever you use, we don't play. Right? We are not like somebody at a slot machine. We carefully have rules to follow. I have 5 thumbs. I gotta go, but thank you for having me, and I hope to see you soon.
Larry, thank you so much, Larry. I really appreciate you doing this, taking the time. It was wonderful, and you're awesome. Thank you very much.
Thank you.
Really appreciate it. Talk to you soon. All right.